Hey guys, welcome back to my financial focus. In this video, I'm going to be going over the balance sheet, and I'm going to be breaking this video up into three different parts because the balance sheet is pretty extensive, as we can see right here. And if I cover all of these really detailed line items in one video, it'll end up being like an hour-long video. So I'm just going to break it up into three parts to make it easier for the viewers to watch and whatever, things like that. So as we can see right here, for the balance sheet, we have two columns right here, December 31st, 2020 and 2019. A balance sheet is basically broken up into two separate balance sheets, one for the prior year and then one for the most recent reporting year. In this case, this is the 2020 annual report for Tesla. And we saw that in the income statement and the cash flow statement that they usually report 3 different years. And so off the rip, that's one way that the balance sheet differs from the other financial statements, is that they usually only record 2 of the reporting years as opposed to 3 of the years. And all of these financial metrics that we see in these two columns are reported in millions. So whenever we see something like this that says cash and cash equivalents 19,384, what that really means is $19,384,000,000. So we just multiply all of these by a million, and that gives us the actual value for these individual line items. And we can see that the balance sheet is broken up into 3 parts: assets, liabilities, and equity. And the reason why it's called the balance sheet is because the total assets are equal to the total liabilities and equity. As we can see right here, total assets 52 million or 52,148,000,000, and then total liabilities and equity 52,148,000,000. And the reason why they're equal is because whenever an accountant is recording the journal entries for a company, they're not only debiting the debit accounts over here like cash and property, plant, and equipment and inventory, but every time they debit one of these asset accounts, they're also crediting one of the liabilities and equity accounts. So let's say, for instance, that a company raises cash by issuing stock. The accountant in Tesla's case would credit a journal entry for common stock, meaning that the common stock account would increase by a specified dollar amount. That's however much capital they raised. And then they would debit the cash account for the exact same amount of capital that was raised from issuing common stock. And so that's basically why the balance sheet balances between assets and total liabilities plus equities, because every time they credit a liability or equity account, these accounts increase, and when they do that, they also debit an asset account for the same amount of money, and so the asset account increases by the same amount of capital or decreases by the same amount of capital. And so now for this particular video, I'm going to be focusing primarily on the assets, and then I'll get into liabilities and equity into more detail in the videos that I upload later on. So right off the bat, we see the first line item, assets, and an asset in financial accounting is basically any resource or anything that has future positive economic value that's owned and controlled by a business or an economic entity. And these assets right here can typically be converted into cash at a later date. And right underneath that, we see current assets, and current assets in accounting is basically any asset that's expected to be sold or consumed or exhausted through the normal operations of a business within the current fiscal year or operating cycle or financial year, whichever is longer. And this is pretty interesting because for some businesses, the operating cycle can actually be 18 months long as opposed to 12 months long. And so in that case, the current assets would include all of the assets that might be sold or consumed within the next 18 months. But typically for like 90% of businesses that report their earnings or their financial position in their annual reports, their operating cycle typically ends at about a 12-month period. As we can see right here, December 31st, 2019, December 31st, 2020, it's only about 12 months. And so right underneath that, we see cash and cash equivalents. And this is the most liquid of all of the current assets. Liquid meaning that this is the asset that can most easily be converted into cash, or in this case, it's already cash. So it starts off at the top because the assets are listed from most liquid to least liquid as we get further and further down the asset section of the balance sheet. And cash equivalents is just made up of the total cash that's sitting on the balance sheet that the business is sitting on. And then cash equivalents is basically made up of short-term commitments or investments, so things like marketable securities that can easily be converted into a known cash amount, typically in less than 3 to 6 months. And so it's recorded in current assets because current assets records everything that can be converted into cash within the next 12-month period or operating cycle or something like that. Next, we see accounts receivable net. And net receivables are basically the total amount of money that's owed to a company by its customers. And so we just take the total amount of accounts receivable. So in Tesla's case, every time they sell a car to a customer but don't actually receive cash for that transaction right at that moment, then they might sell it to them on credit, and so they would record that as an accounts receivable. And the reason why it says net right here is because of an account that is kept off of the balance sheet, but that is normally recorded in the journal entries or in the notes to the financial statements on the annual report. And it's called allowance for doubtful accounts. And what that means is it's basically the amount of accounts receivable that a company is expecting to not be paid. And so it's basically just the default risk of these customers who might have bought a car but aren't going to actually pay Tesla the money that they owe Tesla. And so accounts receivable net is basically just the total accounts receivable minus the allowance for doubtful accounts. And then we get that line item right here for accounts receivable net. And the next line item is inventory. And inventory is pretty straightforward. It's just made up of all of the raw materials, the work in progress goods, and the finished goods added up together right here into inventory. And it's basically just the goods and materials that a business is holding on to with the ultimate goal to resell them, produce them in some production capacity, or to use them in some future economic event of sorts. And then right here underneath that, we see prepaid expenses and other current assets. And prepaid expenses, this is basically just money that's set aside for goods or services before the delivery is received. And so this can be made up of things like rent payments, for example. Tesla might prepay a certain amount of rent for a future 12-month period, and then they'll just incur those rent expenses as a part of the operating expenses on the income statement for the specific period. So if they pay prepaid expenses for an entire year and they're recording income for like January, February, March, April, then this account for rent, in this case is the example, would be reduced by however much the monthly rent was at each monthly period on the income statement. But for the balance sheet, it just records the entire amount that was paid before the economic value was actually received. And then right here we see other current assets, and this is just made up of any cash and cash equivalents, accounts receivable, notes receivable, or inventory that didn't really make it into these separate line items, and so they recorded it in this account right here. And people watching this might think that it's kind of confusing that an expense would be recorded as an asset. But we have to remember that an asset isn't necessarily just like something that is like revenue or an expense. It's something that will produce a future positive economic value. And so in this case, since they might have paid rent prior to actually renting out the space in the months to come, they know that by renting out those spaces, they're going to be able to use those spaces or facilities or property to create revenue for themselves in the future. And so that's why it's considered to be an asset, because it has future positive economic value. And then right here we have total current assets, and this is just the line item that adds up all of the current assets together, and that gives us the total current assets. Then right underneath that, we see a line item that's more specific for Tesla, and that's operating lease vehicles net. And what this is basically Tesla has a direct vehicle leasing program where they lease vehicles to different leasing partners, and they're able to bring in revenue that way or generate revenue. And this line item right here, this operating lease vehicle net, it's just recorded at cost minus accumulated depreciation. And so they're just taking all of the vehicles that they leased out to these different leasing partners. They're recording these lease vehicles at cost, and then they're depreciating them over time using a straight line depreciation method that's basically just depreciated over the contractual period for whatever the contract was for the individual lease agreements with their leasing partners. So you just take the cost of the vehicles minus the depreciated amount of those vehicles, and then that gives them the operating lease vehicles net. Solar energy systems net is very similar to operating lease vehicles net, except it doesn't apply to the leased vehicles. It applies to their solar panels that they install into residential areas and things like that. And so this is basically just those solar panels minus the accumulated depreciation. Then property, plant, and equipment net, or otherwise known as PPE sometimes, or net property, plant, and equipment. This is basically just the value of all of the buildings, land, furniture, and other physical capital that a business might have purchased to run its business, minus the accumulated depreciation expenses. So this could include things like their gigafactories that they have in Nevada or Texas or Berlin and things like that. And they're basically just recording these plants at cost and then subtracting the accumulated depreciation that they're recording on their books over time. And that gives us this line item value right here. Operating lease right of use assets is pretty similar to operating lease vehicles. And so it's basically same thing, just the amount of capital that they spent on these leased assets minus the depreciation moving forward. And then intangible assets net. Intangible assets are basically assets that aren't physical. So this includes things like goodwill, brands, intellectual property like patents, trademarks, copyrights, and things of that nature. And so this line item right here is basically just the sum of the carrying amount of all of those intangible assets. And then in this case, it's excluding goodwill because goodwill gets its own line item right underneath that. And it's just taking the sum of all of that as of the balance sheet date in December 31st, 2020, minus any accumulated amortization or impairment charges. And amortization is basically just depreciation except for intangible assets as opposed to physical assets. Then right here we have goodwill, and goodwill is a bit of a complicated line item, but to keep it simply, it's basically just when one company acquires another company for a price that's greater than the net asset value of the company that was acquired. Whatever the difference is between how much company A paid to acquire company B, that gets recorded as goodwill. And this is, of course, open for future impairments or amortization or things like that that could render this goodwill amount useless moving forward. And then right here we have other non-current assets, and this is just all of the other long-term investments that are recorded on the balance sheet that are not really expected to be converted into cash within the next 12-month operating period. They're expected to be converted into cash like later on past that point. And so this just includes everything from property, plant, equipment, other physical property or investments, long-term investments that a company might record on their balance sheet, but they just weren't big enough to be included with their own individual line item. And so they were all summed up and included in this account right here. And then after that, we have total assets, which is basically just all of the current assets plus all of these non-current assets. And that gives us the total asset account. And that basically wraps up this first part 1 of the balance sheet video that I'm going to do. I'm going to be doing part 2 and part 3 after this, which is going to cover liabilities and equity. I might include both of these in one part. I'm not sure yet. I'm still figuring it out, but I do want to be as detailed as possible. So I'm just trying to break them up into different parts so it doesn't end up being like an hour-long video or something like that. Leave a like on the video if it provided any value, subscribe to the channel, and I'll see everyone in the next one.